Happy New Year. In this episode, my son Jake and I discussed 7702, Insurability, and a little bit about the wisdom of Solomon. We had fun. Hope you enjoy listening. Thank you. Welcome to the Banking with Life podcast. I'm your host, James Neathery, and I have my youngest son, Jake, today.
Jake Neathery, folks. I'm back. Third time's a charm. Well, actually, fourth time. I was on that little Thanksgiving episode where, Megan was so nice to shove me off the chair, just because I speak the truth. I mean, that's what happens when you speak the truth. People get angry. So,
Right.
It's just a side effect of all that. But no, this is our New Year's podcast. I'm really excited because we have a lot to look back on from this past year and a lot to look forward to. Last time we talked, the 7702 hadn't really come out yet, right? That those changes hadn't actually been made.
Well, some of the companies had put them out.
Absolutely. A lot of the companies we had written with at that current point had not put that product out when we last talked. So by the time
the companies go ahead.
No, I was gonna say by the time the podcast came out, I think that those effects had already been made. But when we had first talked about it, they hadn't happened yet. So I think we're gonna have quite a bit to talk about here today about that.
All the life insurance companies want to wait. So the 7702 changes must be in force and effective January 1 of 2022. The life insurance companies, as competitive as the life insurance business is, they all want to wait to the very end to release their products because they always want to be better than the other companies. So, But now, here we are. I mean, actually, this is recording right prior to Christmas. Mm-hmm. But so the 7702, most of them are all out. Yeah,
they are.
And cool. So I can't really remember what my suspicions were on the 7702 other than it was going to take less death benefit, which is correct.
Yep.
But so you being building an awful lot of illustrations.
Yes, sir.
What are your comments on that?
It's very interesting to see the changes. You were dead on with the death benefit is absolutely reduced, especially in the early years. A couple of things I've seen with different products, different companies. We don't write with one company, just shocker of shocks. I know a lot of folks, they want to focus on one company, things like that. But we don't write for just one company. So, I've been testing on several different companies and I've seen a few different things. So a couple of the companies I've seen reductions in cash value and death benefit, but they weren't major reductions. I mean, very slight reductions. Another company I'd seen a pretty major reduction in the death benefit, especially in the early years. But I've also seen more cash value. So, I mean, for banking purposes, it hasn't hurt you necessarily. For your death benefit purposes and death benefit buying, absolutely, there's a change there.
Death benefit becomes more expensive.
Yeah,
basically.
Much more at certain companies. So, it's not maybe as dramatic as a lot of people thought. I know I've talked to a lot of our clients who were worried about the 7702 and its changes and what it was going to do to the policies. And at the end of the day, it's just not going to be a massive difference either way, especially when you get out to, actual age of mortality. Most of those death benefits and cash values catch right up like what they were, originally. I think James has said it quite a bit. Life insurance is life insurance and it's all priced appropriately. So, just when it comes to your actual mortality, there's just not going to be a massive difference from what we originally seen to what we're seeing now. So, yeah.
Well, I think it's a boon for the life insurance companies, number one. Mm-hmm. So what's really changed in the 7702? And there's tons of stuff that has been put out there, but basically for the quote unquote 4% guarantee, which you hear about all the time, this kind of taken advantage of and maybe miscommunicated. So the basis of values for a life insurance policy to be built, the 4% previously has now, January 1, 2022, the companies have a choice between 3.75 basis of value down to 2%. And what you'll see is, and it's almost counterintuitive. Mm-hmm. So if you have a basis of 3.75, it's going to produce a higher death benefit and a little bit less cash value in the early years. Mm-hmm. And if you have a 2% basis of values, 2% guarantee, I'm just telling you, this 4% guarantee and the 2% guarantee is so misinterpreted or misapplied. It's really taken advantage of. You do not earn a guaranteed 4% on the cash values, which is what is heavily promoted. Not true. Okay. So the 2% basis of values now will produce a greater cash value. It's almost counterintuitive, right? And a lesser death benefit. And they do. There's curves in every policy, curves and numbers curve into the future at different points in time. What happens is you have a higher cash value in the early years with the 2%, but the guaranteed cash value side goes down and the non-guaranteed side goes up, the dividends, right? So not that you should make a decision on any one particular characteristic of a or any life insurance company, but it's going to separate the men from the boys. You're going to quickly determine what companies actually legitimately make an effort to pay a dividend and which ones don't. So if the non-guaranteed cash values go up, it's relying heavily upon the dividend. So if you got a life insurance company that's going to reduce your dividend because you practice banking, or they don't make a straightforward, honest effort with the dividends, it's going to affect you.
Yes. And one thing a client and I had talked about, and I had pointed out, a lot of people get this, thing in their head where, they've heard other agents talk, and these agents talk about, oh, there is this, 4% guarantee. And then, a 5.5% dividend. Let's just say that, right? The dividend rate's 5.5%. So they think they're going to make 9%, or that's what they try to put out there. That's exactly what's implied on purpose.
Yeah.
So now the guarantee goes down to let's just say 2%, right? So that guarantee goes from 4% to 2%, but the dividend rate stays at 5%. How is there more cash value in that first year? How? Because that's counterintuitive to what they're saying.
Yeah,
that's not how it works. These are all components of a life insurance.
It's going to be interesting how marketers position themselves.
Yeah.
At the end of the day, I'm telling you, it's a boon for the life insurance companies. Lesser death benefit, the cost of mortality, not even the cost of mortality, well, the cost of the death benefit goes up. And so as you go out into the future, if the cash values rise, there's a net amount at risk. The net amount at risk is the difference of the accumulated cash values and the death benefit. So the net amount at risk lessens over time. It's a boon for the life insurance companies. Now, two, you didn't have a choice. I didn't have. Did you have a choice? Did the IRS call you?
No. Did they ever call?
Yeah, exactly. Well, no, they don't call. They send letters.
That's right. Just for you people out there, they do not call you. They absolutely will send you a letter, though.
One time I was actually going to a seminar that I was presenting, and it was it might have been a banking. It was something. I don't. Nelson wasn't there. It was downtown Fort Worth, and I'm driving early in the morning, right? And my phone rings, and it's a guy saying he's from the IRS, and he's like calling because I owe him money, and they're going to send a policeman and issue a warrant. And I'm just laughing at the guy. It works, or they wouldn't do it.
Absolutely,
the IRS doesn't call.
That's right. So,
and my point there is we didn't have a choice. None of us had a choice. The life insurance companies have wanted this. They slipped it in like every other nefarious bill ever. This was a component to a bill that had already passed or was already going to pass. It's almost like the Federal Reserve Act on December 23rd, right? 1913. There were 6 senators. Didn't even have a quorum. But let's, who wants to know about history? Okay.
Ooh.
My point here is we didn't have a choice, and the life insurance companies didn't either.
Yeah.
Right. They were told in January, you have to implement these products by January 2022. It costs, and I'm not taking up for them or feeling sorry for them, but it costs a lot of money for these life insurance companies to revamp these products. Yeah. So they had to get to it. Anyway, we didn't have a choice. It is what it is.
It is what it is. So speaking on the 7702, I had a client ask me, how does that affect my current policy?
Not at all.
Yeah.
Nothing.
These are for policies in the future. I know some policies, like the changes go in force hard January 2022. There is no, let me try to get it in right now. So if you call us right now and say, hey, I'm going to get a policy, yeah, it's too late. So,
and if I was a young person, look, I just went through underwriting. I mean, I'm still waiting for hopefully I get standard. I'm too fat for preferred. And they happen to be on 2020 products, but I've got some term riders that I'm going to convert in 2022.
Yeah.
Who cares? I buy life insurance.
Yeah. I bought a term policy this year. By the way, we can talk about that. I'm buying a term policy right now. Well, before
we get off on, and we can, but I want to come back to 7702 because I have some additional comments. But go ahead. You bought a term policy? Yeah,
I'm buying a term policy so I can convert that. I'm converting it in 2022. Yeah, no, right. Going right up to an insurability amount. So, but yes, no.
Did you go over a little bit and ask for forgiveness?
I did. So
I'm just asking.
It was what it was. And sometimes you can get some forgiveness. And I think we do a lot of that in our practice.
You've got to justify it. You can't ask these underwriters to go outside
That's right.
their norms. All right.
And if they do, they deviate very little. I mean, it's not enough to make you go, oh,
you got to justify it. If you're going to ask for something from the life insurance company, you have to justify it.
Yeah.
Anyway.
Absolutely.
Well, good job. So you're going to be fully insured or properly insured. Is that what I'm hearing?
Yeah. Properly insured, fully insured. I think that's a year-to-year thing. So
absolutely.
But yeah, no, I will be at that point.
I'm going to be like Nelson Nash. I'm going to, my dear friend and mentor, I'm going to keep buying life insurance until they say, boy, you're just not insurable. I don't care.
I love that.
Yeah. Well, let me say on the 7702 too, in addition to what I've said, because of Nelson, I haven't gone into the depth of going through the different iterations of policies, but here's what I firmly believe in when it comes to the changes in 7702. In our practice, we may change products a little, depending on age and the client specific. Each client has their own solution. So the idea that one size fits all is not in existence. It's not true. It's not appropriate. It won't serve you well. But I think that the base premium should be higher.
Absolutely.
In general. And the term component that's required, if any, is going to be much less if we're going to practice banking.
Much less. And that's a couple things you'll see. Clients who have policies already and you're getting new policies, you're going to see that cost of that term is going to be much less. We don't need as much term. And of course, we're also going to want to use more base too. So I think there's this whole thing out there in the big wide world on this negative connotation when it comes to the base part of a policy, which is absolutely ridiculous. The base part of your policy is going to be a driver in the future years of the policy and even in the early years of your policy. It absolutely provides cash value.
I guarantee the base face amount, the increasing base face amount, and the base face amount increases because the base produces dividends.
Yes.
Okay, now just think about this. So the increasing base face amount, the base whole life policy's face amount must equal the cash value, must equal the increasing death benefit in the future at age 121. Absolutely. At the end of 120 years, you're age 121. It's very simple. Do you want a small death benefit at age 121? Or a large one? And then, do you want to do business with the company that puts the curve? I mentioned the curve on the numbers in a policy. Do you want to do business with the company that puts the curve past 120 or past 105? You know dang well most of us are not going to live there. That's an actuarial, theoretical life expectancy.
Yep.
All right. And the answer is no. I don't want the curve to happen after I'm most likely not here.
Yeah.
Okay. But I want a big number.
Absolutely.
So I need a big base.
Absolutely. And so when we also talk about the policy's basis of guaranteed values, we're talking directly about what the base is producing. We're not talking about the PUA and what it's producing in cash value. We're not talking about the dividends and what they produce in cash value. We are specifically talking about the base part of your policy. So when you hear people, tout, the 4% or 5%, whatever that guarantee happens to be, they are specifically talking about the base part of the policy. I will die on this hill. Why are you trying?
They don't know. I agree with you, but I suspect most of them don't know what the hell they're talking about.
Yeah, you're probably right about that.
I talked to an agent earlier this week. He's like, I'm just calling around looking for, an agency that I can work with. Are y'all still working with companies that have the 4% guarantee or the 2% guarantee? And I'm like, you don't even understand the question that you're asking, because he's out there, selling his clients a 4% guarantee.
Yeah.
And I'm like,
I'm sure it's 100% base policy.
How'd you get my phone number?
Yeah, right.
No, I don't know. He thinks he's I don't know what he's doing. I know he doesn't know what he's doing.
Yeah.
By the questions that he asks. Anyway.
Yeah, no, I mean, it's a very faulty way. You hear this a lot with, these, what would you say, talking heads, these people who think they're, infinite bankers. These people usually aren't associated with the Nelson Nash Institute, by the way. Hey, but at the end of the day, that you can quickly find out if somebody's legitimate or not by looking them up on the practitioner finder. If they're not on there, you can just go ahead and they're not even on your radar to think of as legitimate. They really shouldn't be. So if they are on the practitioner finder, I'm not saying you shouldn't have, your suspicions or your walls up still. But at the end of the day, they're more reliable than the people who are just out there on the internet talking. I've heard one guy who said Nelson's book was 200 pages. It's a quick read. It's 200 pages. It's 93 pages, man. You don't even read the book. You would know that it's. Yeah,
it's been around 200 years, but you got to read a book that, some guy named Nelson Nash made it popular, wrote a 200-page book, But so he doesn't read and he don't want you to read, so that you should just buy his software.
That's right.
Right, and use 4% guarantee. I think the policies, now all things can never be equal. Mm-hmm. All right. But comparatively, I think you can get closer to a straightforward policy that Nelson built in his book, and he built several different scenarios, several different policies, producing several different solutions. We can get closer to that than we have been able to previously.
Absolutely. That is one of the big boons and benefits of the 7702. These policies are looking more like what Nelson had built originally. Yeah. So I like that a lot.
We just happen to be in a much lower interest rate environment.
Yeah, absolutely. That's the negative there. And then on top of that, the death benefit reduction. I think so many people discount death benefit when it comes to the infinite banking concept. Yeah. I get it, right? Nelson said your need for finance, exceeds your need for death benefit. Absolutely. He's 100% right about that. But let's not discount death benefit. That is, Nelson, his family had, taken advantage of that as well when he passed. At the end of the day, we're all going to pass at some point in time. Death benefit's important.
Yeah, well, let's talk about that too. The death benefit is important. There's no question. And you should solve for that. If you have dependents and that, you need to be responsible and acknowledge your responsibility and then address them, right? Mm-hmm. I've said it many times. Years ago, I sat down with a couple and the guy kept going on and on. I'm like, I don't want to make her future boyfriend rich. It's I finally they had to leave my office,
Did you end up kicking him out?
Yeah. I'm well, it's part of what, it's a component of this profession, in my opinion, the nobility of the profession. People don't buy life insurance if they don't have loved ones or things they care about.
Right.
So, but once your need for death benefit is addressed, then the focus is on becoming your own banker, because we didn't start out at 19, 20 years old understanding this banking concept, right? Mm-hmm. So we're all playing catch up. And I'm just saying that you have a need for death benefit. Well, look, if I started out at 19, I might have been married at 19. Okay, maybe I'm 17 or 18, right? And I thought I knew everything, but I didn't, of course, right? I'm just saying if I'd have started life insurance policies for the sole purpose of practicing banking, you know, and then I was an honest banker throughout my life, I would wind up with more death benefit. Eventually, the underwriters are going to say, no, we can't put this in force. But let me tell you this, too. I was talking with a colleague the other day, a professional in California, has been in the industry for 30 years. And if the insurance regulators show up at your office, Mr. Insurance Agent, Mr. Advisor, Mr. IMO Agent passing through the industry, right? And there's not a need for death benefit in your solution or your offerings, there's going to be the conversation's going to take a different tone. Oh, at the end of the day, this is life insurance, period. Anyway.
Absolutely. So, hey, so a couple of things. I have a couple of questions that I gleaned from some clients that they've talked about. And
perfect.
One guy, I really appreciate this comment because I think sometimes we're a little bit too close to this. I think we think in terms of, you know, I guess a higher level, you know, when it comes to the insurance industry, when it comes to, you know, building banking policies. And I think sometimes we just very simple things that we almost gloss over sometimes because, you know, we're not really, it's not where we're trying to hide anything from you or, you know, miss anything here. It's just one of those things that I think when we're having a conversation, you know, we're talking at our level, not necessarily at other people's level.
You know, I experience that. I go to a restaurant, right? And the staff, the wait staff, you know, goes through all their specials and the chef recommends this, blah, 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 blah. And they say it so fast and they're normally young. They're very professional. And I'm like, wait, you know, I appreciate that you say this 20 times a day. This is the first time I've heard it. So, and I really want to hear it. Would you say that again and go, you know?
Absolutely.
I get it. So and then the industry has its own vernacular, its own terminology. And so this young gentleman had pointed out, when we talked about insurability, and we're talking about, you know, the death benefit you can have. So let's say the maximum death benefit I could have is $1 million, right? That's the maximum death benefit I can have. Okay, so I buy a policy with an underwritten amount of $1 million. So it produces a first year death benefit of, let's say, $700,000. But over the time period, right, it's going to increase each and every year. That death benefit's going to increase. Okay, well, let me go into that so to have a first year death benefit of $700,000, but it took $1 million in underwritten amount. So all of these insurance companies, if you have a life insurance policy, you can go out into the third, fourth, fifth year, and that's really the number they're underwriting for. Why would they do that, James? Because that's how conservative they are. All right. So there's the difference between the underwritten or the underwritten amount to put a policy in force. The underwritten amount is higher than the first year death benefit.
Absolutely. Okay. So if you're underwritten, if your insurability is $1 million, right? We can underwrite you for $1 million, but that's not going to be your first year death benefit. It's more than likely going to be lower than that number. So say it's $700,000, but by the time the 10th year rolls around, you have $1 million too. By the time, you know, you actually get out to age of mortality, maybe it's $3 million. Now, this client had said to me, Jake, does that mean I only get the $1 million because that's what I'm insurable for? And then as I get older, the amount that I'm insurable for goes down because it's a multiple of your income.
And age.
And age.
So as we get older, but our income should be going up too, but there's still a multiple. The multiple goes down. Yeah. So how old are you?
So I am 30, just turned 30.
Have just turned 30. That was months ago, man. Okay.
Hey.
Did you backdate your term to save age?
I did backdate my term to save age.
You could backdate up to 6 months to save age. Okay. So you can have like 30 times your income. That's a factor. I just turned 58. And I think I can have 15 times my income. So the factor goes down. But the income should be going up, but you're still going to hit a limit. So
his question was, Jake, well, what if my insurability is $750,000 in the future? My policy says I have $3 million in death benefit. Does that mean I only get $750,000 or my family only gets $750,000 when I pass?
Oh, I got it.
And I said, no. That is an underwritten amount. That is what we are underwriting for when we're buying policies. Now, if you have $3 million in death benefit and your insurability, maximum insurability, $750,000, you're not getting another policy. But that does not mean, at least on yourself, you can obviously buy policies on other people, but that does not mean that when you pass away, your family's only getting $750,000. I got it. So
no, that's just the underwriting requirements have to be in existence at the time of underwriting.
Yes.
Right. So I could have a business partner and the insurability is the insurable interest is there. Mm-hmm. The insurability is predicated upon the business deal in my example. So we could be partners and get the insurance in force. Go forward 10 years, our partnership could have dissolved. We could have walked away. Mm-hmm. That policy, in my example, I could still own it. I could still be the beneficiary. And so when the partner graduates, I'm still going to receive the death benefit. And I've been paying the premiums the whole time. But now I have to hunt down his family or their family to make sure that I can come up with a death certificate, right? And if somebody graduates, not anybody off the street can go get a death certificate, mm-hmm. right? So my point there is that the insurable interest must be in existence at the time of underwriting.
Absolutely.
Right? It's like the third party market, the tertiary market is what it's called. Yeah. If, life insurance is an asset, mm-hmm. just like an automobile, it's privately owned, right? Mm-hmm. If I have an automobile, I can give it away or I can sell it because mm-hmm. it's mine.
Yeah.
I have full title and rights and control. I'm the owner. Mm-hmm. Life insurance is the same way. I could sell my life insurance as an asset to the tertiary market, secondary market, tertiary market. The life settlement companies are a secondary market. Now, I'm not advocating this. All right. Mm-hmm. You do not sell your life insurance policy. My opinion. Don't do it. It affects you in ways that is not good for you. Mm-hmm. And we can talk about Larry King. You can Google Larry King, right? Because once you sell a policy, then all of the life insurance companies are going to view you as selling your mortality, and they're not going to give you new coverage if they know about it, right?
Yeah.
So anyway, I can do that if I wish. I'm still the owner. The insurable interest could be gone. Mm-hmm. It's like a secondary market. If I bought a policy, I'm the owner, I'm the beneficiary. There's really no insurable interest there.
Yeah.
Right. But the insurable interest existed at the time that policy was issued. And then there's a whole another tax consequence to buying policies off the open market.
Which kind of fits into my next question or another client's question. They said they're uninsurable. So I think this particular client had a heart attack when they were younger, and it was severe enough that they're uninsurable. They've been told they're uninsurable. They don't have any children. Their parents are long gone at this point. They're not married. In their own words, I don't have anyone to insure. Can I get an IBC policy?
You can find one available on the open market.
So you can buy one because it is an asset you can buy, but
but somebody has to be willing to sell.
Exactly.
You have to know them, and
yes, sir. So it is what it is. You're not getting a policy just on any random person. I think most I've seen is you can sometimes buy one like on a business partner. I mean, every once in a while you can do like a charitable organization, depending on how much you are, contributing to that charitable organization.
There's insurable interest between business partners. The business has to be evaluated.
Yeah.
A buy-sell agreement, a key man policy.
Yeah.
And there's limited death benefits, right? And then the charitable, like if I'm a donor, the entity that I'm donating to does have an insurable interest in me.
Absolutely.
Because if I die, my future contributions are going to die with me. Mm-hmm. But it's limited, but it has to exist.
Yes.
Yeah. So what'd you tell him?
Just kind of what we went over. I mean, there are different things you can do. One is buying a policy. I didn't say that so my answer is I don't have anything for that. We don't sell our clients' policies. I don't have any current clients that want to sell their policies.
And the agent really can't buy those anyway.
Yeah, we can't
it violates their contract.
Yeah.
Because really, insurance the death benefit is tax-free because it is a replacement of a loss.
Yeah.
Right? It is not an investment for a gain. It is not. So whenever you sell a policy, the insurable interest existed, at the issue. But now the new owner, the first thing they're going to do is change beneficiaries. And now they're going to, quote unquote, profit from your demise or your graduation. That then becomes an investment. Therefore, the taxation is different.
Absolutely.
So, if you want to make an investment, go make an investment. And I get it. You should make that capital investment from a life insurance policy loan.
Yeah.
So it's hard. We don't get into that. Now that's not to say I wouldn't buy every policy that became available, right? But who has time to track down somebody? And most people in the infinite banking world are not interested in selling their policies.
No, they understand the value of it. That's why they bought it. So
exactly. And they experience the values why they keep it.
That's right.
Right. And it's the same thing. I've had a lot of people, well, why would people do that? All you got to do is look at an in-force illustration or an illustration. And yes, they're wrong the day they're printed, but you can make the case of why you would purchase a policy from someone just by understanding what's going on in the policy. As a matter of fact, I have one on the conference room table, the gentleman, Uninsurable, an older gentleman, I forgot what state he's in, an old Prudential policy.
Oh.
Demutualized, and they're still paying dividends. And I told him, it was like, get an in-force illustration. He thought he might want to sell it. I'm like, send it to me. And then I showed him exactly why he wouldn't want to. And turns out he didn't want to, which is the best decision for him. But I'm telling you, I'd have flown up there and wrote that man a check.
Right?
Prudential, demutualized in 1985 or 1990. Still paying dividends, going like gangbusters. It's like, you see the premium, sir? Yes, sir. You paying that? Yes, sir. Did you see the increase there? Yes, sir. Why wouldn't you do that? Nobody's ever shown me that, James. And then it led into a great conversation. He really should be a podcast guest, an episode, right? Because I'm like, well, see how far or how accurate I am. See how close I am. Your whole life, you've been told this is the worst investment ever and you shouldn't pay those premiums and you're paying too much premium and life insurance is the world's worst place to put money. He said, yes, sir. I've been embarrassed in prior years. This is an older gentleman. And he needed money, right? Or he thought he needed money. He thought he needed more money than he actually needed. And I said, have you ever borrowed against that? Oh yeah, I borrowed against it. And he even had a current outstanding loan, right? And then when you take them through the machinations or the mechanics of the life insurance policy with actual in-force illustrations of it, this is a 20-something-year-old policy or longer.
Nice.
30 or 40-year-old policy.
Oh, that's going to be nice. I don't care who you
It was unbelievable. Yeah. He said, I'm like, if you need income, this is how you take income from this policy. All right. If you don't need income, don't take the income. And repay. And, I mean, you just went there. I helped the gentleman the best that I could. Yeah. And he wound up keeping the policy.
Good.
Right. Good for him. But my point is, I'm a buyer, but it's really not good for the seller.
Yeah.
Okay.
More than likely than not. And also remember, if you do sell your life insurance policy, like James had said, most companies aren't, jumping at the bit to insure you at that point. And then even beyond that, and even if you could get insurance again, right? Let's just say a company would take that risk on you to you made the mistake, whatever. You've also limited your insurability because that death benefit's still outstanding on you. That policy is still outstanding on you in your life.
Yeah. There's a question on all life insurance applications. Have you ever sold? Do you have any intentions of selling? And when you're honest on that application, they're not going to issue a policy. Yeah. But, what goes on in the big wide world, I don't know what some of these agents do. That's why I don't hang around them. I don't know.
Hey, okay. Not all of you are bad. We spent some time with some really cool agents, over the, before the Thanksgiving holiday.
I love agents. I encourage them, but the ones that need to be cracked on,
should be cracked on.
If you identify, look,
Yeah.
If you're out there creating the noise, you know who you are. Just stop it. Move on. Go back to your mortgage days, your real estate days, your chiropractic days, or whatever it is you did before,
They're just marketers, man. And I don't even.
No disparagement. I mean, it's like.
Yeah. I mean, they're just selling what they can. If they could sell water or whatever, they would sell water. I mean, at the end of the day, like they're just selling what they think they can sell. And I mean, they don't have any love for you as a client. I mean, that's why they do what they do. If they actually want to practice the infinite banking concept, they would get involved with the Nelson Nash Institute, and we would figure out very quickly whether you should be with them or not. Not saying that that's foolproof or anything like that, because I know anyways.
I think they're sincere, some of them, and I think they're sincerely wrong. but they have an opportunity to learn just like all of us and change their mind or do better. And so that's my encouragement. I spend more time with agents than
you should.
Yeah. So, but my heart really goes out to agents. I appreciate agents, and I really appreciate the agents that are trying to do the right thing. And I believe that's most of them. So, and I know many of you that listen are agents, and I appreciate you listening.
Yeah.
So thank you.
Yeah. I think one last question here. We had talked about this earlier because it was a pretty funny question. But a lady had sent this in. She had said she has 2 children, but she really only has the premium to insure one of the children. She has a 17 and an 18-year-old, and she asks, which one should we insure? You had a very funny response to that. So last question here. I'm pushing it over to you.
It was a sincere response. I'm like, listen, I'm surrounded by strong women. My mother was a strong woman. My sisters are strong women. My wife is a strong woman. The women in my office are strong women. And it's like, I wouldn't wade off into you couldn't pay me to wade off into that. I would refer to Solomon when the mothers were arguing over a child. And he told them, okay, well, cut the boy in half and each of you take 2. And the mother's like, no. So
yeah,
I wouldn't wade off into that. I would refer to Solomon.
Yeah.
And I disagree with the question.
Yeah.
Of course, we don't make recommendations without having a full and robust understanding of your financial situation. Mm-hmm. We're not just selling life insurance so you can become your own banker and hope it works out and whatever. So to answer that question appropriately, we of course need more details. And I don't, unless the one child's uninsurable, okay, but if they're both insurable, I would figure out a way to get it done. And I think I can get it done. And I think whoever asked that question just doesn't have enough information, or that she wouldn't ask that question in the assumptive fashion that she did.
Yeah. And I think a lot of times.
It's a genuine question.
Yeah. And I think a lot of times people think maybe it's better to insure the younger child than it is the older child. Like you'll get more cash value out of it, or it's, better for my policy that I own to have a younger child on it than an older child. And, at the end of the day, like we've been talking about this entire podcast, insurability. Underwriters are looking at insurability. If you have 2 children, both are dependent, 17 and an 8-year-old, and you're going to insure only one of them, what do you think that underwriter is going to think?
Yeah, you're going to kill the other one?
Yeah, exactly.
Or this is one you're going to kill.
This is the one you're going to kill. You're trying to get insurance on it so you can kill this child. It's like it's bad business. It is bad business to insure just one child. You need to insure, if you have multiple children, all of them equally as possible. And
that's not really necessarily, we don't have the time to get into it here, but there is a proper expansion. If I want to become my own banker, there's a proper place to start, and there's a natural expansion. If you build the correct foundation, you can build any structure you want on a correct foundation. And so that proper expansion is that proper foundation to expand upon.
Absolutely.
Yeah. There's a lot here, and there's a lot more. I'm excited. It's a New Year's episode, right? So
absolutely,
this kind of talked about 7702 over the last year. That was really the major change, and going forward, I don't know. It's going to be bigger and better. I know I'm focused on client only content. I love these podcasts. I love the long form, the short form, the clients, the Q&As. I love all of that. But we're building client only content because, I want my clients to feel special, and I hope they do. And I want them to have something that nobody else has. So,
I love that.
which they do. I just want to add to that.
Yeah, absolutely. Well, Happy New Year.
All right. Happy New Year. Thanks for listening.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.